This is 12th of January 2026, and for today's video I will be doing a back test on gold, and we're going to see how price made use of the first presented fair value gap, which is normally formed after the open of price, after the open of the markets at 9:30 a.m. and we're going to see how price made use of the first presented fair value gap and how significant the first presented fair value gap is in price. Now, before we go on, always remember to set your time zone at New York so you don't get any of these lectures wrong. Time zone set at New York, okay? And this is the backtesting for the London session. So I have a video on this, and you'll be seeing a video on the screen at the end of this lecture. The key zone for the New York AM session is from 8 a.m. 8:30 a.m. to 12. Now we're focused on the New York AM session to 12 p.m. Okay, and the market opens at 9:30 a.m. This market open 9:30, and make that red. 9:30. Okay, this is the daily time frame, and gold is currently at an all-time high right here. Now, like I still always say, you can't predict the tops of the market when the market is at an all-time high. Like you see this movement in price. This was once, you see this swing in price. This was once an all-time high. Okay, that was last month. This was once an all-time high, and with this down movement, with this strong down movement in price, some traders will assume, okay, there is actually a change in structure on gold. Okay, a change in the bullish direction to price being bearish. Okay, meanwhile, watch what price did the opposite. So this movement right here might actually catch so many traders off guard. Okay, now, since we can't predict the top of price, the tops in price, okay, we can't predict when price is likely going to become bearish because it's at its all-time high. Okay, it's better you anticipate each day, each and every day, to be bullish, for price to want to go upward until you see a significant movement or a significant drop in price that will signal to you that, okay, there is actually a change in the direction of price. It's better you anticipate bullish movement, okay, for each day, especially if you are a day trader. You see this drop right in price, drops into the daily suspension block. This is also a daily BC, okay, buy side imbalance, sell side inefficiency. Why? It has offered buy side and it's short of sell side delivery. It has offered buy side delivery and short of sell side delivery. So this is also a suspension block for those who have gone through ICT concepts, and you know suspension block. This is also a suspension block. But for those who are new, this is a daily BC, okay, buy side imbalance, sell side inefficiency. It has offered buy side delivery and it's short of sell side delivery. So that's why you see price coming into it to offer what sell side delivery before rallying up. Okay, and I said last week on my backtest that price will likely take out this high, and it did. I think during the London session, that was when price took out this highs. Okay, and you can see the displacements with which price took out this high right here. So let's go into the smaller time frame so we can go into the business for today. Okay, let's go to 5 minutes, then we drop down to 1 minute. Let's see, 15. Okay, 5 is better. Okay, so I'll remove this London annotation so your focus remains sharp on the New York AM session. Now, now you see this movement in price, taking out what this eye and this eye. What are these eyes called? They are called buy side liquidity. I mean, what's resting above these eyes? Buy side liquidity. And we can agree to that. Also, this eye is slightly higher than this. Okay, validates it as a buy side liquidity. Okay, it means there is actually a pool of liquidity with which price would want to trade into. So you see, after price took out these highs, there was no reversal downward. Instead, there was a continuation in price upward. Now, if there is a continuation in price, there is usually a retracement. Okay, let's say there's a continuation. Like in this case, there was a continuation upward. There is usually a retracement in price. Okay, usually to take out sell stops from lows or to trade into an inefficiency to continue the upward movement. Like this right here, this is a fair value gap. This is an inefficiency. So you see this swing movement in price, this swing here and this eye right here. So at this point, price is at premium. So what if price is to retrace down in price, it's going to retrace down to a discount before the rally up continues. So if you notice, let's leave it out. Okay, this was the end of the swing leg. This is a swing leg. Okay, this is a swing low and this is a swing high. What validates it as a swing low? It has the higher low to the right of it, to the left of it, and the higher low to the right of it. Here's the candle. It has the higher low to the left of it and the higher low to the right of it. Then at the top is a swing high. Why? It has a lower low to the left of it and a lower low to the right of it. So that's how you know your swing lows and your swing highs. So at this price leg, up here, this is premium. Okay, that's why I said when price was at this zone, at this level right here, it was at premium. So price going down to this point, it's actually going down to a discount. Okay, and also our fair value gap right here is at the discount level. So let me annotate this fair value gap. Okay, if there's a volume imbalance, you give room for the volume imbalance. Okay, so this is a fair value gap at the 5 minute time frame. You can see price rallying into its respecting the zone, though it traded below it, okay, and closed below it, but it went back up and rallied upward. Now our daily bias is bullish. Okay, now after this run up in price, taking out these highs and price at premium, and you know that price is going to trade into discounts at this level of interest, and also we'll be we'll be anticipating a run up in price. Now, how do you go into this trade? Now, I'll probably not go into this trade like this, but there is a way to go into this trade. So let's say your buy limit is placed at the top of the fair value gap while you anticipate price to go into the fair value gap. Okay, and your take profit should be above this high. Okay, now this is not really a good risk to reward ratio. Okay, so entering this trade, it will be better on the 1 minute time frame, and that's why I'll be talking on the first presented fair value gap after the market open. So the first presented fair value gap after the market open is very significant because price uses this level to go upward or downward. Price makes reference to this level, and I keep the one being formed on Monday throughout the whole week. The first presented fair value gap that has been created on Monday, I extend it in my chart and I keep it there for a whole week because price is going to make use of it. So this is 9:30. Okay, 9:30 is when the market opens, and the first fair value gap after 9:30. This is it's 9:31. This is the first fair value gap being created after 9:30. You see the low of this candle, the eye of this candle at 9:30, and the low of this candle at 9:32. Okay, that's a fair value gap. So I'll make it orange. Like I said, I normally extend it all through the week and keep it on the chart all through. So this is the Monday first presented fair value gap. Monday first presented fair value gap. Now at 9:30, price was already working its way on this 5 minute fair value gap created here. Okay, and at 9:31, price gapped up. At 9:32, after the close of this candle, 9:32, the Monday first presented fair value gap was being formed, and you see how price traded above it, then traded above it, closed above it, and traded into it. See how price respects this level. The Monday first presented fair value gap, trades above it, closes above it, then trades into it, pays it up. Price rally upward and was only able to trade into the upper section of the Monday first presented fair value gap. Okay, you see the movement upward. And like I said, if I was to be on a trade like this, my take profit would be at this high. Okay, so since price is at its all-time high, there is no data at the higher time frame to frame your there's no data at the higher time frame to know where price will likely run up to. Okay, so this is the high where you should be taking your profits. So a trade like this would be, you know, and don't take my word for it. Always extend your Monday first presented fair value gap all through the week. Extend it through the chart and leave it on your chart throughout the week and see how price respects this level. So your stop loss will probably be at this low and you take profit. So that's about 1.93 is to revolution. That's not bad, actually. And also, if you miss a trade here at the first presented for value gap, you see this run up right here. See this down close candle followed by this up movement. This is an order block. They change in state of delivery in price. Sell side delivery being offered, then buy side. Okay, so the moment this bullish candle trades above the open of this bearish candle, it becomes an order block. Okay, so this is an order block. And also price also created a fair value gap. This is very visible right here. Okay, and you see price trading into the order block, filling the fair value gap and trading into the order block. So that's also an opportunity to go long in this kind of market. I'll make this right, just a minute. Okay, beautiful. Also, there are also so many opportunities to go long in price. Actually, this is also an opportunity. Price taking out this ice right here. Okay, at this, see this swing in price. This is like a mini version of what I explained on the 5 minute time frame earlier. So this is a swing in price. This is a swing low and this is a swing high. I explained it earlier on. Okay, so this is actually premium and this is discount. And what did I say about price when it's at premium and it wants to continue upward? It goes down into a discount. Okay, this is discount. And also at a place at a point of interest, this is a fair value gap, a small fair value gap. So one can actually go long right here if you missed this setup for the first presented fair value gap and also this. So at this point right here, price hasn't traded up to these highs where our take profit lies. Okay, so you can actually also take a trade right here. There's a fair value gap here. You see how price trades into it and rallies upward. Take out the high. And we are currently at the launch macro. So at the launch macro, there is actually an opposite movement in price to the movement it has done on the New York session or on the previous session. So you see how price, after taking out this high, started running down. Okay. So I hope you found this insightful, and I will encourage you to do your own backtest, your own journals to see how these things works in price. So have a good one and God bless.